Hi. I wanted to send an update on the markets, which went into full-blown panic mode this week. I think a couple of things brought the panic on. First, on Wednesday, the World Health Organization classified the coronavirus as a pandemic. There was also a travel ban implemented on travel to the US from Europe. There was all these sports cancellations. And then you had the first US celebrity, Tom Hanks, be diagnosed with the virus. On top of it, we're in a crazy political climate with it being an election year. And there's also an oil price war going on right now in the Middle East. So people fear that this will all bring on a recession, which typically means cutbacks, job losses, and a hurt to the economy. The other problem is that this feels like a different type of correction, one that we can't stimulate our way out of. First, you had the Fed cutting interest rates a half a percentage point. You had them floating proposals around payroll tax holiday, as well as a stimulus to industries hit hardest by the coronavirus. And all these have fallen flat so far, and the market has shrugged them all off. So it's hard to resist the urge of the herd right now, stampeding to the exit with your investment portfolio. But I want to urge you not to, and urge you and recommend you not to take that approach. And try and time the market. It's impossible to time the market. And even if you pulled your money out now to the sidelines, waited until things look better, it's impossible to know when the bottom is going to be. It might be next week, next month, or next year. But by the time that it looks like everything is clear and it's good to reinvest and go back in, the market will have already recovered by that time. And all you really would have done is lock in losses by selling when things have gone down and purchase when things have appreciated and gone up. It's really the reverse of what we all should be trying to do. I haven't seen anyone be successful with a market timing approach, and nor has any successful investor like Warren Buffett or John Bogle seen people that have been able to do it. So how do we handle it? First, we make sure that your short-term cash needs are accounted for. That means if you're withdrawn from your accounts, you have enough in liquid cash or short-term conservative investments that you don't have to sell anything that has gone down in value, and you can wait till the prices come back. Secondly, the investments in your portfolio are strategically allocated according to risk. That means that the risk that's in your portfolio, it's correlated with how much risk you're comfortable with and how much risk you should be having to meet your goals, not more or not less. Third, I'm a proponent of rebalancing the investments in your account so that we stay close to that targeted risk strategy. Rebalancing is periodically buying or selling investments to bring the portfolio allocation back to the strategy. This usually means selling things that have appreciated to buy things that are lower in cost. Usually it means selling stocks and purchasing something more conservative, but it could be the reverse. So here are two recent examples when rebalancing occurred and usually it actually worked. So in December of 2018, when the market experienced a 10% drop due to the Chinese trade war as well as Fed raising interest rates, a rebalance at the end of the year purchased more stocks as stock prices declined during that December downturn. And having more stocks enabled the portfolio to take advantage of the big jump that came as quick as the next month in January, but also for the entire 2019 year where there was a good stocks had a good return. But at the end of 2019, the rebalance would have sold some of the stocks as stocks had a big rise for the year, and the proceeds would have been used to purchase more bonds or fixed income. But doing this would have helped hedge some of the losses that we're seeing now in the market. So lastly, I'm a proponent of diversification. So a lot of sentiment around bonds is that they're useless because the interest rates are so low and they don't pay any interest, and you can get an even bigger cash flow from dividend paying stocks. And that's true, but fixed income provided a buffer against the recent market drops. As an example, the price on long-term treasuries, they're up 25% year to date. So it hedges some of those losses that we've seen. We don't know how long it'll take for the market to recover, but there are some positive things to take note of. Historically, when we see rapid declines in the market like we see with this one, the recovery is usually quicker than if the decline had been a gradual one. Also, businesses and industries in China are coming back online. They're opening back up, and their stock market has recovered almost all of its losses since the virus started there. Also, I talked about the stampeding herd earlier. The herd isn't really the one who's selling in this case. Fidelity, Vanguard, Schwab, they came out yesterday and said that they see people still investing, still putting money into stocks and not running for the exits. The swings that we're seeing now are mainly caused by the computer algorithms of institutions that triggered these sell-offs. It's easy for me to say, don't worry about it. Markets make corrections. But I know you've worked hard for this money and have legitimate concerns, and I'm always here to talk.